In this video, we're going to look at the flow of manufacturing activities. For a manufacturer, they have three types of inventory. So since they make their own products, their process starts with buying raw materials. These are the components that go into manufacturing the product. The raw materials that are purchased stay in a warehouse or in inventory until the factory is ready to start making the product. When the production department is ready to start manufacturing the product, they'll request raw materials to be sent to the production floor. At that time, the raw materials get transferred to the work in process inventory account. During production, they will start with the materials and then add labor and overhead in the production process. If products are completed during the accounting period, they get transferred to finished goods. If at the end of the accounting period they're incomplete, they will stay in work in process. Whatever is finished gets transferred to finished goods, and they will stay in finished goods inventory until they are sold. When the goods are sold, they are expensed to the cost of goods sold account. Let's review the schedules and the T accounts that go with each of these activities. First, we're going to look at the raw materials account because that's where everything starts. In the raw materials, we know that raw materials is an asset, so the beginning balance of an asset is on the debit side. This beginning balance is whatever the raw materials the company started the year with, and this was what they ended the previous year with. Increases of raw material inventory happens when the company buys more inventory. So purchases increase raw material inventory. Remember, if the company paid any freight in to bring these items, to bring these raw materials to the place of business, those are included in the cost of purchases. Then, whenever the company uses raw material inventory, I'm going to actually use the word direct materials here because remember we do have indirect materials. Whenever the company uses direct materials are credited or decreases raw material inventory, and then anything that's not used remains in their ending balance. In this example, I just looked at one side of the T account, so we didn't look at debit and credits here. Just wanted to show you how things are affecting just the raw materials inventory T account. And now this is direct materials used. Let me complete that and say direct materials used. These direct materials used gets transferred to work in process inventory. So direct materials used decreases raw material inventory and increases work in process inventory. What else happens now in the work in process inventory? In the work in process inventory, we know that if there was any work in process inventory during the beginning of the period that was incomplete, that would show up here because work in process inventory is also an asset item. We got the direct materials used that, once the production starts, we requested and they got transferred to the factory floor. So we got direct materials used. To that, we add direct labor costs, which also increases work in process inventory, and then factory overhead. So I'm just going to say overhead here. Overhead also increases work in process inventory. Once production is complete, once all the work is done, the goods are transferred to finished goods inventory. So work in process inventory gets decreased for, we call this cost of goods manufactured. These are completed the manufacturing process. That decreases work in process inventory and it gets transferred to finished goods inventory. Let me come back to finished goods inventory. Let's finish up work in process inventory. Anything that is not completed, or rather incomplete items, will remain in work in process inventory and become part of the ending balance. Now let's look at finished goods inventory. These are completed items. The finished goods inventory account is an inventory account. It's an asset account. So unsold items from last period are shown in beginning balance. Cost of goods manufactured is what was finished during this period, so that increased the finished goods inventory balance. Anything the company sells decreases the finished goods inventory, so we call that cost of goods sold, and then cost of goods sold, as you know, also gets debited to the cost of goods sold expense account. And it's shown as cost of goods sold is increasing. As you remember, that gets reported on the income statement. Going back to the finished goods inventory account, anything that is unsold in finished goods and remaining in inventory becomes the ending inventory of finished goods. That is the flow of manufacturing goods in T account format. When you're doing your homework, you may be asked to prepare a schedule. As long as you understand the flow of inventory, you'll be able to follow along with the schedule. Here is a schedule to calculate direct materials used. If you are asked to calculate direct materials used, you can find direct materials used in two places. You find it in your raw materials inventory account, which is here, or you find it in your work in process inventory account here. Both these numbers are the same because raw material inventory decreases and work in process inventory increases when the factory starts producing the goods. Let's go through the direct materials used schedule. We start with beginning raw materials inventory that you get from the T account here. So that's one. Raw materials purchases are added to that. Again, that is right here in your debit side of your T account. Beginning raw materials inventory plus purchases equal to raw materials available for use. So all you're doing is just adding the debit side of your raw materials inventory account. Next, you subtract your ending balance of inventory, which is 3 here, to come up with your direct materials used. So I'm going to label that 4. The reason I'm labeling the schedule is so that if you are used to the T accounts, sorry, this is 3 here. If you're used to the T accounts, you can kind of relate where all these numbers are coming from and why we're preparing a schedule. It's because a lot of times they'll just give you a data table and you'll kind of have to know how to calculate direct materials used. We're used to T accounts, so if you know where all these numbers are coming from, these schedules tend to make more sense. Now let's look at work in process. For work in process, you may be asked to calculate the cost of goods manufactured or prepare a schedule of cost of goods manufactured. Cost of goods manufactured is in two places. It's on the credit side of your work in process inventory, and then it gets transferred to the debit side of the finished goods inventory account. So as long as you can figure out either the items from finished goods inventory or the work in process inventory, you'll be able to calculate the cost of goods manufactured. When you're doing a schedule of cost of goods manufactured, it's basically just a schedule of everything in these three accounts put together. The schedule of cost of goods manufactured starts with the direct materials information because we need direct materials used to calculate cost of goods manufactured. So the first part of the schedule of cost of goods manufactured is simply this calculation moved to the top. So the top part of that calculation is how to calculate direct materials used. Once you get direct materials used, we know direct materials used was the fourth item I labeled. Well, that's the same thing here. 4 and 4, it's the same thing. One gets transferred to the other account. Then from there, you add direct labor, which I'm going to label 5, and that is in your work in process inventory account. And then factory overhead, which is item number 6. A lot of times in the schedule of cost of goods manufactured, you do have to detail what the different items are for overhead. So if they ask you to identify individual items, you would list them here and then put the total of total factory overhead. So basically that's what you're doing here, is the total dollar amount of factory overhead. So 4, 5, 6 together is called total manufacturing cost. So here you're just adding item number 4, 5, and 6 and calling it total manufacturing costs. To that, you add your beginning work in process, which I'm going to call 7 here, which is the beginning balance. And then that is called, when you add 6 and 7, that's called total cost of work in process. Again, total cost of work in process is all the items on the debit side of the work in process inventory account. Our goal of preparing a schedule of cost of goods manufactured is to figure out how much is the cost of goods manufactured during the period. To do that, we are going to subtract the ending balance of work in process, which I'm going to label item number 8 here. And that is less ending work in process to give us cost of goods manufactured, which I'm going to label 9. So all this verbiage here is the schedule of cost of goods manufactured. And in your homework, you're going to be required to know how to prepare a schedule of cost of goods manufactured. In most cases, they're going to give you a data table with all this information. If you're comfortable with the T accounts, my recommendation is put everything in the T accounts and calculate these numbers. Then you can plug that information into the schedule of cost of goods manufactured. If not, if you're comfortable with the cost of goods manufactured schedule, you can just plug in these numbers directly to the schedule. Now, let's look at calculating cost of goods sold. We know cost of goods sold is calculated in the finished goods inventory account. Of course, it's there in cost of goods sold T account as well, but the calculation, we need to look at finished goods inventory. The calculation of finished goods starts with the beginning finished goods inventory. I'm going to label that 10. To that, we add cost of goods manufactured. So we know cost of goods manufactured came in when goods got completed from work in process inventory. So that's the same number 9 here. These two are the same. So that's 9. And 9 and 10 added together is goods available for sale. Then you subtract ending finished goods inventory, which is, I'm going to label it 11 here, to come up with our cost of goods sold, which is 12. We already talked about cost of goods sold calculation when we're looking at income statements, so this should be familiar. Sometimes when you're working on homework problems, you may be required to calculate cost of goods sold. However, you'll have to calculate numbers in each of these T accounts to determine cost of goods sold. For example, if you are asked to calculate cost of goods sold and you were missing cost of goods sold and cost of goods manufactured in the finished goods T account, you'll have to first figure out cost of goods manufactured before you calculate cost of goods sold. And we know cost of goods manufactured came from work in process inventory account. Finally, we're going to be looking at what happens when goods are sold. We had said that cost of goods sold decreases finished goods inventory. That decrease, or the credit, that amount gets transferred, it gets debited to the cost of goods sold account. So this is also 12. That's the same number. That's it for this video. I know it was a lot of information. Be sure to review it 2 or 3 times and take your notes. If you have any questions, please let me know.